On July 24th, 2026, a tiny stock called Stack did something almost no company ever does. In a single trading session, it exploded 602%, rocketing from an open of $1.23 to a close of $9.27, with an intraday high of $12. And then within minutes of the closing bell, it collapsed 48%, all the way down to $4.80. This is the anatomy of that move, told through four separate analyses: the sentiment and news, the fundamentals, the technical swing trade setup, and the final buy-or-sell verdict. By the end, you'll see why every one of those four reports reaches the exact same conclusion. Let's start with sentiment and news, because this story begins with a headline, not a business. The supposed catalyst was a press release from June 8th, announcing plans to form a majority-owned U.S. subsidiary to build modular gas-to-electricity generation systems for AI data centers. On paper, that sounds like a company writing the biggest theme in the market. But look closely at the timing. That news was already 6 weeks old. The stock had traded quietly for a month and a half after the announcement, and then it suddenly erupted on July 24th with no new material information at all. When a stock moves 600% on old news, that is the signature of a social media-driven retail pump, not a real change in the business. And here is the first serious red flag. Stack's actual business has nothing to do with AI. Its core operation is oilfield specialized vehicles, the pumping, fracking, and repair trucks used in oil and gas fields. It is not an energy infrastructure company, and it is certainly not an artificial intelligence company. The so-called AI subsidiary is a non-binding memorandum of understanding, not a funded, operational, revenue-generating entity. In other words, the exciting narrative and the actual company are two completely different things. Now let's look at how different groups of investors reacted, because sentiment is rarely uniform. Mainstream financial media stayed neutral and cautious, describing shares that surged after heavy speculative trading pushed a microcap to the top of the week's gainers. Social media, especially Reddit, was the opposite, euphoric and bullish, hyping the spike out of the $1 range. Short sellers, the traders betting the price will fall, were aggressively bearish, with short interest climbing above 90% of the float. And the most telling voice of all was the post-market itself, where a 48% collapse showed sellers taking profits as fast as they could. When you line up the bullish and the bearish factors side by side, the bearish case clearly dominates. On the bearish side, the post-market collapse, the extreme 90% short interest, a stale 6-week-old catalyst, a microcap that is easy to manipulate, and a volume-to-float ratio near 15 times. On the bullish side, there were really only two arguments: a genuinely hot AI power theme and short squeeze potential from that low float. But both of those were already exhausted, because the squeeze had, in fact, just happened during the day itself. Now watch the price action laid out across the calendar, because the shape of the move tells its own story. On June 8th came the press release, with the stock near $1.30. By June 26th, short interest had reached 91%, and the stock sat around $2.60. On July 17th, it was quiet at $1.92, simply consolidating. Then July 24th, it opened at $1.23, spiked to a high of $12, closed at $9.27, and cratered to $4.80 after hours. A tenfold move from low to high, and nearly half of it given back, all inside a single day. So the sentiment verdict is unambiguous: bearish, avoid, with high confidence. The single most important clue is that the move was already reversing before most people had even heard the story. Now let's turn to the fundamentals, and here the raw data snapshot shows you exactly why this stock is so fragile. Its market capitalization was around $87 million, which is tiny, a true microcap. There were roughly 10 million shares outstanding, but the float, the shares actually available to trade, was only about 4 million. And against that tiny float, volume on July 24th hit somewhere between 59 and 67 million shares. Stop and think about what that number really means. A float of about 4 million shares, but nearly 60 million shares traded, means the entire available supply changed hands 14 to 16 times over in one day. That is not patient accumulation by long-term investors building positions. That is distribution, the very same shares being flipped again and again in a speculative frenzy, passed from seller to buyer at higher and higher prices. Now strip away the narrative completely and check the underlying fundamentals of the company. Stack is a Chinese oil and gas equipment manufacturer. It has no analyst coverage, meaning not a single Wall Street firm publishes a rating or a price target on it. There is no recent earnings data, and there is zero revenue from AI or from data centers. At $4.80 in the after-hours session, the entire company was valued at roughly $45 million, a valuation built almost entirely on a single press release. So when we assemble the risk picture, the warnings stack up on every dimension. Pump and dump risk, very high, the classic pattern of stale news, hype, huge volume, and a post-market collapse. Short squeeze exhaustion risk, very high, because the squeeze that could have driven prices up has already played out. Liquidity risk, high, because post-market volume was thin, so the 480 price might not even hold at the next open. Fundamental risk, high, because the real business is oilfield equipment and the AI story is only a memorandum. And regulatory risk is real too, since regulators tend to scrutinize unusual trading in microcaps that move violently on no material news. Now we come to the technical and swing trade picture, and we'll walk through it one indicator family at a time, starting with momentum. The Relative Strength Index, or RSI, measures how overbought or oversold a stock is on a scale of 0 to 100. Stacksla closed with an RSI of 72, which had just pushed into overbought territory above the key level of 70. But here is a genuine anomaly worth pausing on. The Commodity Channel Index, the CCI, was still sitting at minus 161, which is deeply oversold, even after a 600% day. Those two readings should not coexist, and the contradiction means the move was so fast and one-sided that the indicator simply could not keep up. Historically, that kind of violent dislocation often precedes a sharp snapback in the other direction. The MACD did produce a bullish crossover, but remember, MACD is a lagging indicator, so it confirmed the move only after it had already happened. Next, the trend indicators, which on the surface all looked bullish. The 5-day, 50-day, and 200-day moving averages had all crossed upward. Parabolic SAR flipped from sell to buy, and the supertrend indicator turned green. But there is a crucial catch in the ADX, the average directional index, which measures how strong a trend actually is. The ADX was only 23.6, sitting below the 25 threshold that defines a genuinely strong trend. So despite a 600% day, the trend structure was never even confirmed. This was a one-day parabolic spike, not a durable uptrend. The volume indicators told the same story of exhaustion. 67 million shares against a 4 million float is more than 16 times turnover, which is textbook mania, not healthy buying. The price closed at $9.27, above the volume-weighted average price, or VWAP, of $7.48, but that gap really just measured how overstretched the move had become. Then look at volatility, which had blown out to a statistical extreme. The stock closed at $9.27, while the upper Bollinger Band sat at just $7. That means price closed 32% above the band, which is a 2-standard deviation event. Statistically, when a stock stretches that far above its bands, a reversion back toward the mean becomes highly probable, and the average true range had doubled to 158, confirming the volatility spike. Across multiple timeframes, the message stayed consistent. On the 4-hour chart, RSI was above 80, extremely overbought and in an exhaustion phase. On the daily chart, it read as a classic blow-off top on 16 times float turnover. And on the weekly chart, it simply registered as an outlier event far outside normal behavior. Now let's map the key price level so we can see where the stock might actually travel next. Resistance sits up at the $12 intraday high and again at the $9.27 close. The VWAP at $7.48 represents fair value for all of that day's volume. Support then steps down, first to $4.80, the post-market level, then to $3.44 where the 20 and 50-day averages converge, and finally down to $1.36 at the 200-day average, the pre-rally base. For a swing trader deciding whether to hold a position for days, the red flag checklist is damning. A stale catalyst, a core business mismatch, extreme volume to float, a post-market collapse, and a prior identical pump on July 16th that also crashed the very next day. Add zero analyst coverage and no fundamental justification, and you have 7 out of 7 pump and dump red flags, all confirmed. So what are the actual swing trade options here? The first is buying the dip, and it is simply not recommended. This is not a pullback within an uptrend. It is a blow-off top, with roughly 80% of downside back toward the pre-pump range near $1 to $2. The second option is shorting the stock, which is possible but genuinely dangerous. A nano cap with only about 10 million shares can trigger a violent short squeeze on any coordinated buying, and that is exactly how trading accounts get destroyed. So the recommended swing trade action is neither. It is simply to wait, stay on the sidelines, and let the dust settle. That brings us to the final buy or sell verdict, where all of the evidence comes together. Every one of the 7 pump and dump red flags is confirmed. The stale June 8th catalyst, the business mismatch, the 6.7 times float turnover, the 48% post-market collapse, a prior identical pump, zero analyst coverage, and no fundamental justification whatsoever. Now weigh the two possible outcomes honestly. The bear case carries roughly 95% probability. The smart money has already exited, and the stock should bleed back toward $1 over the coming weeks. The bull case is maybe 5%, a possible dead cat bounce on Monday, but that is a trap for latecomers, not a real opportunity. And here is the most important insight of the entire analysis. Both sides of this trade lose. Do not buy because you would be purchasing a completed pump and dump with 80 to 90% of downside ahead. But do not short it either, because a coordinated squeeze on that tiny float could tear a short position apart. When both buying and shorting are traps, the only correct move left is to avoid the stock entirely. If the price does unwind from here, the likely path is fairly clear. The Monday opens somewhere between $350 and $550. Next support at $344, fair value near the 200-day average at $1.36, and eventually a return to the pre-pump base around $1. So the final verdict across sentiment, fundamentals, the swing trade setup, and the buy-or-sell decision is exactly the same in all four: avoid, 95% confidence, and a critical risk level. As the report itself puts it, the time to buy was $1.17 at the open, and the time to sell was $12 at the peak, or $4.80 in the after hours. The time to do anything has now passed. This trade is dead. Move on. S-Stack is a case study in how stale news, a tight float, and social media hype can manufacture a spike that vanishes almost as fast as it appears. This has been an educational breakdown of a published analysis, not financial advice. Always do your own research before making any trading decision.